Recession predictions have increased. Is that what it'll finally take to bring mortgage rates down? I've got that update and more coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Yeah, mortgage rates have stayed stubbornly high. If you were just kind of an outsider and not really looking at all of the details, but sort of just theorizing here, we've got CPI, or inflation, has come down, not to that 2% target, but in the 2s or around 3%. We've had the Fed funds rate, this is the interest rate, the overnight lending rate between banks that the Federal Reserve sets, that typically kind of influences the rest of the interest rates throughout longer terms. The Fed has decreased that interest rate a little bit, not nearly as much as many people want them to, but we've seen those two things occur. We should be seeing mortgage rates coming down as well, and we haven't. Mortgage rates have stayed stubbornly high, adding sort of fuel to the flames to housing affordability and how difficult it is for especially new people to buy houses or to move these days. And when you add on top of that potential straining on consumers, when you add on top of that the tariff policy and will we see tariffs or not, it's causing more and more people to say, hey, we might see a recession on the horizon. I've done a few videos about how to make sure that you're prepared or even recession-proof your finances. But if we do see that recession, is there a silver lining? And will we actually see, is that what it will take for us to see mortgage rates finally come down? Well, let's take a look at history. We obviously have a lot of that. Recessions happen, every 5 to 7 years, depending on the time frame that you're looking at here. So let's take a look at history. This is a noisy chart. It goes back, 50 years and plus, but it's important that it does because it shows the dramatic increase and rise in interest rates that we saw last time we had, this hyperinflationary time period. And you can also see this shows interest rates in the early 80s went up, then came down, then went up again. Guys, that's what happened with inflation. We're hoping that doesn't happen again this time. If you're trying to give the Fed some credit why they haven't lowered interest rates as quickly, they're trying to prevent a double top here with inflation like we saw last time back in the early 80s. But let's take a look. This is interest rates, okay? These are mortgage rates, 30-year mortgage rates, and the gray shaded area, those are recessions. And if you zoom in, and maybe the easiest one to look at is the Great Financial Crisis. Why? Because it's the widest gray bar. You can see clearly that mortgage rates declined in the second half of that gray bar. And if you look in more of some of the smaller bars as well, that tends to be what occurs. You can see interest rates maybe going down in the second half of those recessions. A couple reasons for that, and one is that you don't know you're in a recession for at least 6 months, if not 8 months. And the reason why is even though the National Bureau of Economic Researchers, that's the think tank that officially says we're in a recession or we're not, oftentimes it's after a couple of quarters of negative GDP, where the economy is actually contracting. And that's the simplified definition. We obviously had that a couple of years ago, but the National Bureau of Economic Researchers never officially called a recession, so technically it wasn't one. But if you think about that, 2 consecutive quarters of negative GDP, that's 6 months, and then it usually takes a month or so to even release that data. And then the National Bureau of Economic Researchers, they don't meet on a regular schedule. They then evaluate the data and make a call. So we don't even know we're in a recession, i.e. the Fed can't even really start lowering interest rates, which then hopefully has a trickle effect on mortgage rates. They can't even do that for 7 months, at the earliest 8 months. And if the typical recession only lasts, a year and change, 18 months or so, then you're not going to see interest rates decline immediately once you see these gray bars. The 2 times that stand out is pretty peculiar are actually the closest to what we're experiencing right now. Back in the short recession in 1980, 1981, and then in the 1982-83 timeframe, you see interest rates spike right as we are entering a recession. Whether that caused it or not, or helped contributed, that's open to debate. But those are times of extreme inflation, and therefore Volcker and the Fed needed to raise interest rates in order to try and tame inflation. And of course, right, that coincides with a awful time period in the overall economy, an awful time period for many consumers. And yet, at the tail end of those, you'd see in both where interest rates came down. So noisy chart, messy chart, but yes, historically, typically when we see a recession, mortgage rates do end up falling. Not at the beginning, not right away, but they do end up coming down. And that's because interest rates, the Fed funds rate, is one of the tools that the Fed uses to manipulate and influence economic activity. And so when they're trying to spur the economy on, they'll lower interest rates, and typically mortgage rates will follow after the Fed does that. So if we see an economic slowdown or recession later this year, is this time going to be different, or will history follow through? And it's difficult to say that, well, this time's going to be different, but if you look at the reasons right now that, well, inflation is staying elevated above sort of the Fed's target, but also there's a discussion and a new policy, trade policy with tariffs and so on, and that could influence inflation in the short term. It's very possible that we don't see interest rates, if we see a recession, that we don't see interest rates decline, at least not very quickly, and that leads us to one of the most dangerous economic terms out there, and that's stagflation, where we actually do have higher levels of inflation generally overall, and yet little to no economic growth. And I think that's the big concern on trade policy. If we do see tariffs, and in the short term, many economists believe that at least initially they can be inflationary, as there's a price resetting and baking that into prices, then yeah, we could see elevated levels of inflation. And corresponding, the Fed is not able to lower interest rates because they're fighting inflation, and yet we're seeing very low economic activity and i.e. a recession. That's stagflation. Those are very, very challenging to get out of, very challenging to, I mentioned that the Fed has different instruments or tools or maneuvers to try and help spur on economic activity. During stagflation, they're very limited in what they can do because they've got to fight inflation, and yet their primary weapon to spur economic activity, lowering interest rates, isn't really at their disposal. Now, that's not my base case scenario that we see stagflation, that we actually do see elevated levels of inflation, that interest rates stay high and we see a recession. It's possible, not my base case. I don't think it should be yours either. The question is, are you prepared? Are you prepared? Have you made sure that financially you're taking appropriate steps so that if we do see an economic slowdown, financially you can navigate through that challenging environment just fine, okay? Work with your certified financial planner, look at all 6 areas of your financial life, run that stress test. Well, if we do see an economic slowdown, am I prepared? What adjustments would I need to make? Do I need to make any adjustments right now? Work with your CFP on that. If you don't have a CFP on your team, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.